Hello, we are from Group 2. So, our group members are Pamade, Boemil, Andy, James, Fika, and me, Hafian. Hence, on this special occasion, our team are going to share with you a book summary called The World is Curved: Hidden Dangers to the Global Economy by the author David M. Schmick. I hope you guys who's watching can relax and enjoy. Well, without further ado, let's get started. David Schmick is considered as the most insightful financial market strategist in the world. For more than 2 decades, he has conferred with central bankers such as Alan Greenspan and Ben Bernanke, and advised top Wall Street executive investors from George Soros to Michael Steinhardt to Stan Druckenmiller. Political leaders such as Bill Bradley to Jack Kemp have regularly sought his policy and advice. The World is Curved. Pick up where Thomas Friedman, the book The World is Flat, left off, taking readers on an insider tour through the private of central bankers, finance minister, and even prime minister. Schmick reveals how today's risk environment came to be and why the mortgage mess is a symptom of potentially far more devastating trouble. He wrestled with 2 questions on everyone's mind. How bad could things really get in today's volatility in economy, and what can we do about it? Next, it is going to be presented by my colleague Bu Emil.
Thank you, Hafian. Now my turn. My name is Emilani. I will share with you the summary of Chapter 1, The End of the World. The book describes us how the industrial world was facing a full-fledged liquidity crisis, the Great Credit Crisis of 2007 until 2008. In a flash, the World Bank and other financial institutions had stopped making loans. The global financial systems was split sliding and the stock market crashed back then. And a decade later, in the fall of 1998, New York Federal Reserve President Bill McDonough nervously explained that the collapse and subsequent market rescue of the trading firm long-term capital investment has brought the world economy closer to the edge than anyone had realized. U.S. Treasury Secretary Hank Paulson had recently declared, "This is far and away from the strongest global economy I have seen in my business lifetime." The trigger by the credit crisis and its chain reactions of debt default, after all the problems loans amount to at worst $200 billion in exposure in a global market worth hundreds of trillions. Within a days, the crisis has spread to the commercial paper market, long considered one of the safest bases of investment for money market mutual funds. And suddenly, the one market considered the safest, most liquid, non-government related investment in the world becomes suspect. The lifeblood of the global systems was suddenly at risk as investors poured their fund into the one short-term investment deemed trustworthy, 3 months US. The financial market liquidity is drying up. Most world markets seems in a state of free fall, and the world's credit market stays up as nobody. Now let me bring you to the Chapter 2, A Dangerous Oceans of Money. In 1997, Schmick shared with us how radically the new oceans of money in the global economy was changing the rules of the game. He had the sense that increasingly interconnected global systems was unleashed extremely powerful market forces. Most of the global economies could see globalizations coming as well. The stock market crisis was likely over and the climate will stabilize relatively quickly because of the new interconnected nature of the global systems. That is why the central bank wanted less analysis about Russians and more about what was likely to happen as G7 industrial nations sought to survive and prosper in a rapidly globalizations international systems. That's the summary of Chapter 1 and 2, and my friend will bring you to the Chapter 3 summary.
Hello everyone, my name is James and I'm gonna explain Chapter 3 and 4 of this book. So let's go to Chapter 3, that is Entrepreneurs in a World of Private Equity and Hedge Fund Troublemakers. A hedge fund is an actively managed investment fund that pulls money from accredited investors, typically those with higher risk tolerance. A private equity fund is also a managed investment fund that pulls money, but they normally invest in private, non-publicly traded companies and businesses. Hedge funds are highly agile, largely unregulated, usually global fund for high net worth investors who can handle risk far more than regulated market funds, like mutual funds, would allow. Private equity investors deal with firms not publicly listed on stock exchange and reshape them through mergers, restructuring, or recapitalization to produce more performance. Today, both hedge funds and private equity firms have become the international financial system's new boogeyman, the horrible, greedy monsters blamed by frustrated politicians for the loss of control and occasional chaos associated with today's highly unpredictable capital flows. Indeed, it is true that while some hedge funds operators who earn enormous fees demonstrate an extraordinary level of generosity to those around them, others exhibit a level of greed that is almost beyond comprehension. The private equity world is no different from the hedge funds. There is a considerable amount of hypocrisy too. For years, some high-profile self-appointed leaders of private equity partnerships have complained that the low tax rate on the top bracket for individual income in America rewards the rich too handsomely while contributing to budget deficits. This is the situation that needs to be phased out. Doing so, however, won't be easy because other countries would like nothing better than for Americans' private equity funds to move offshore. So let's move on to the next chapter, that is chapter 4. Tony Soprano writes The Chinese Dragon. Today's conventional wisdom is that China will dominate the 21st century. In this chapter, I will explore how China is a huge unpredictable force with the power to help or sink the world economy. It can be argued that US policymakers have no choice but to try to make our cumbersome, often frustrating relationship with China work. China has no choice but to try to expand their growth. Slower growth rates mean few jobs and thus the potential for greater and potentially dangerous political and social tensions. On the other hand, China, as it expands rapidly, also risks becoming a menacing economy and financial bubble to the world. Already in China, bureaucratic decision makers continue to stockpile commodities with the goal of fueling an ever-growing economic machine. Surging stock markets are beginning to show a dangerous instability. In China, inflation is quickly picking up, which has been accompanied by rising inflationary expectations throughout the industrialized world. When the Chinese bubble burst, China could instantly become a deflationary threat to the world. In the resulting slowdown scenario, China could have no choice but to dump those stockpiles of commodities and finished goods onto world markets. This would potentially cause global price levels to plummet, presenting huge complications for industrialized world policymakers. If that happened, commodity prices upon hitting a tipping point will decline viciously because some of the price increase pressure have been the result of speculators betting on higher prices. Once the upward trend began to reverse, the speculators would quickly pull out and run for the hills, causing prices to plummet. For the next chapter will be presented by my colleague, Pa Andy.
Hey, my name is Andy. I will present about Chapter 5, Japanese Housewife Take the Commanding Heights. Japan mega firms represent roughly half the companies listed on the Japanese stock market, while the highly successful mega firms represent half of the stock market, and thus keep that market strong. The market itself reflects only 10% of the actually Japan economy today. Japan economy is below its nominal peak growth rate of 1997. According to Lehman Brothers, to understand what has happened into Japan economical over the last several decades, began with the yen. In Japan, the yen exchange rate is driving force in every life. In Japan, the man on the street fixated on the Japanese currency. This explanation may at first sound a bit tendentious, but the yen is a useful lens through which to examine the Japanese economic system. Beginning in the mid-1980s, the yen soars in the strength against the US dollar. Encouraged by agreement among the industrial nations called the Plaza Accord to allow the dollar to weaken the reduced global trade friction with the United States. It was specifically during the yen strengthening period from 1986 to 1989 that global commentators talk of a new superchange Japan as buying up the world, led by the Japanese purchase of the American icon Rockefeller Center in New York. Chapter 6, Nothing Stay in the Same. The 1992 sterling crisis. The pouring sound of the global wealth machine will forever remain a constant. The story server of the reminder that as much as grab on the firmly to the certain of the status quo. Change often nicely change in the inevitable. This is particularly the case in economic policy, when human judgment come into play and the power of financial market is grossly underestimated. Every serious player active in the financial world knows in the intellectual level that the global economy is an unstable and constantly morphing structure. They see change in the status quo as the distant threat, but not in the immediate one, as the history shows such a blindness to the reality of the changed world can be very dangerous. The event that unfolded in the autumn of 1992 were totally unforeseen, yet the receipt on the European monetary world has and represent a phenomenon that continues to impact the global economies. This simply limited episode actually redefine the relationship between the policy world and global financial markets. The next chapter will be presented by my friend Vika.
Thank you, Pandi. So, hello everyone, my name is Vika. In today's video, I will take you guys through a journey of Chapter 7, the incredible shrinking central bank. The incredible shrinking central bank, people picture central bank have some magical powers. When a financial market crisis happens, lots of institutions such as the Federal Reserve simply wave their magic wands. Lower interest rates and the financial landscape once again restore to normal. The declining power of central banks may be the most convincing argument for why the world is curved. Because of the weakening economy and an unstable financial market condition, the federal policymaker makes some option for the solution. Option 1. They could slash short-term interest rates dramatically, perhaps by as much as another full percentage point in one fell swoop, with more cuts thereafter. Short-term rate had already been cut several times in the late 2007. So the goal of option 1 is to reposition monetary policy further ahead of the curve. This is what the Japanese central bank back then should have done in the early 1990s. But unfortunately, they didn't. Next up, option 2 would involve more restrained interest rate cutting. The goal of option 2 would be the hat trick of containing inflation, limiting dollar weakness, and stimulating the economy. The risk of this option, however, could be further economic collapse as a result of the federal institution moving too slowly and too timidly. The danger was falling behind the financial curve, and once global financial market trade sensed that happening, they would sink the dollar. Next up will be Chapter 8, Class Warfare and the Politics of Globalization. Today, the world is curved precisely because the political and financial market fell because they simply don't understand each other. This is particularly the case in the United States, where a seismic politics shift away from free trade and liberalized capital market appear to be under considerations. World financial market until now have set the price of US financial assets, including the price of stocks, at relatively high values. This is based on the bullish assumption that the Clinton-Reagan model of free trade, liberalized capital markets, and long-term fast growth will remain largely intact. The question of the hour are: first, how will market in coming years reprice the changing nature of the political environment? Second, will an aggressive downward repricing of financial assets happen in a climate of panic? And the last one will be: will the threat of financial markets of unwise of politic change be very real? None of these analyses, however, is to suggest that managing the political of globalization will be easy, as a global financial system completes the unwinding of the subprime mortgage mess. It appears there would be a few heroes and more than a few villains. Only those politicians with enormous foresight and restraint will be able to resist political demagoguery. Indeed, the banker placed the entire world economy in serious trouble. And the next chapter will be explained by my friend Pak Mandi.
Thank you, Vika. My name is Madeyatna. Let me continue with Chapter 9, Surviving and Prospering in this Age of Volatility. Today, the financial world is a very dangerous place, and our leaders need to open their eyes, especially for starters, where they need to an effective game plan for broad international strategy to reducing growing global imbalance, as well as dealing with the new giant country like China and the other effect of this new superpower country which impact to financial architecture, dollar collapse, and other impact. And in the future, there will be another superpower country will come to the surface. As predicted, many Asian countries will be leading the economy. This shifting phenomenon can be seen now. In 2007, as the subprime loan default, the architecture of the financial system turned to moderate difficult problem into the worst financial panic in the decades. The resulting financial wreckage has seriously undermined political support for globalization and threatened the livelihood of millions of low and middle class families globally. This crisis gives all the stakeholders around the world a good learning. Another case is after the fall of the Berlin Wall produced greater competition in global manufacturing and services. This reduced real wages globally, which led to lower inflationary expectation and thus declining long-term interest rate. All this creating the new imbalance and volatility, and this strategy is always needed to develop to suit or face the new equilibrium which will happen from time to time, including mainly the global financial risk. Controlling bank panic has become extraordinarily difficult because speed is a killer. Today, money moves in an instant. Even 20 years ago, a person had to pick up a phone and call the broker or banker to move their money. Today, everything happens and at the push of a button on the desktop on computers. Therefore, if everybody decided at once in panic to push the button that withdraw deposit from the banking sector, the liabilities of the bank in a bank run of any endurance would be too big, too fast to contain. And policymakers desperately need to engage in collective forward thinking about the nature of the global financial safety net and about risk in general. So the key important questions: how to survive prospering of the business in the age of volatility. With the good leadership, we can continue to build on the amazing prosperity of the past 25 years. Without it, we risk a new era economics heritage. A second Great Depression seemed unlikely, but the thought is no longer a complete absurdity. So, the world is dangerously curved. Thank you.
Okay, so that is all from Group 2 for the book review regarding David M. Schmick, The World is Curved. I hope you have a nice learning journey with us. Hope you also learned new insight on something great to learn from this very video. Thank you very much for watching this, everyone, and goodbye.